Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. I can't thank our guest enough today for stopping by to speak with us again. His expertise with the central banks and global currency changes can help us cut through some of the complication that has risen in the last 2 weeks. As we are recording this today, there's been a major announcement by the Chinese government about its changes to its interest rates. Now, you have heard Paul Sheard here before on the podcast. Most recently, he was on episode 65 back in June when we discussed the ideas in his new book, The Power of Money, How Government and Banks Create Money and Help Us All Prosper. Paul was research fellow at Harvard Kennedy School. Previously, he was a chairman of S&P Global and served that firm as executive vice president and chief economist. Earlier, he held chief economist positions at Standard & Poor's Rating Services, Nomura Securities, Lehman Brothers, and he was head of Japanese equity investments at Barings. He was appointed not once but twice by Prime Minister Hashimoto and by Prime Minister Obuchi to serve on committees of the Japanese government's Economic Deliberation Council, and we're going to get to his expertise in that in a second. And Paul has a BA with honors from Monash University and a master's and PhD from the Australian National University. So welcome back, Paul.
Thanks, Rob. Great to be here.
So we have had lots of central bank moves in the last couple of weeks. I would like to start with what you're thinking about China. The markets clearly listened to it this morning when they cut the rate by 1/10 to 3.45. That's for their 1-year rate, and left the 5-year rate unchanged. There were some downgrades that came along after that with forecasts. There were some people have been talking about some parallels between the condition of China now and where Japan was maybe a decade or so ago. Do you see parallels, lack of parallels in there? How do you see that?
Well, thanks, Rob, for that segue into Japan. But just on the move itself, I think the interesting point, of course, is that we have virtually all developed central banks around the world still hiking interest rates. The Fed's done 525 basis points in the last year and a quarter or so, and probably more to come, and Bank of England, ECB, etc. And here we have the central bank of a major economy going in the other direction. The other interesting tweak there is, again, and of course, Chinese monetary policy, the way it operates is somewhat different from the kind of transparent, flexible inflation targeting framework that we have in the developed world. Mimics it to a certain extent, but it's sort of interesting that in cutting interest rates, they're tweaking at the short end and not doing anything with that 5-year rate. That to me signals perhaps, or what the signal may well be, we think we need to put a little bit of stimulus into the economy here, but it's not at a massive kind of turning point where we have to, push interest rates down right across the yield curve, which of course is what, again, developed world central banks have done for the last 10 years or more since the financial crisis with all their quantitative easing and forward guidance. But obviously breaking news, and that needs to be digested a little bit more. Mm-hmm. In terms of the parallels to China, to Japan, of course, this is a very long-standing theme. I can remember being asked about this, 15 years ago, and writing little pieces in our global weekly economic monitor. And there are similarities, obviously, because again, both major economies at the time that Japan had its asset price unwind, its banking crisis, it was, Japan is number one. It was up there, kind of not threatening, but challenging the US in terms of global economic supremacy. China has taken on that mantle now. And of course, they were both kind of property market stories. Right. And so given what happened to Japan and that sort of, multi-decade funk that the unwinding of Japan's asset price bubble ushered in with the banking crisis and then this very sustained period of deflation, right next door to China, it does beg the question. But I do see, major differences. And one of them, of course, is that China is at a very different stage of economic development.
Right.
If you look at per capita income in China and compare it to the US, it's something like 13,000 versus 80,000, almost US per capita GDP, almost 6 times. Mm-hmm. Economists like to look at those numbers in PPP terms, purchasing power parity terms. When you do that, the gap shrinks, but it's still, a factor of about 3 times. Right. Per capita GDP in the US, about 3 times more than China. And so China has got a lot more, if we just froze the global economy as it is, and just said, well, let's see if China can catch up to the US or even catch up to Japan, for that matter, which is sort of in between, or South Korea, an economy like that, there would still be quite a lot of potential growth left for China to exploit to get to that level.
Okay.
And I don't see any, hugely compelling reason, particularly given China's very impressive 40-year track record now of sustained economic growth, that China can't, get quite a long way, along that path. Not to mention, the fact that the global economy is continuing to expand. We have the technological innovation continuing to drive growth as well, and China is a big part of that story as well. So I'm sort of structurally a little bit prone to be more optimistic about the prospects for China medium to longer term than perhaps you would have been about Japan at the peak of its bubble in 1990. A second difference is that Japan's bubble, it was much more of a bubble story in Japan. In the 1980s, the Nikkei went up dramatically. It was a stock market bubble. It was also a land price bubble, driven by credit growth.
Crazy, yeah.
But it was less of a sort of a residential investment or a huge property market investment story. It was much more of an asset price bubble.
Right.
And of course, that's more dangerous because bubbles unwind, and when they do a lot of damage to bank balance sheets and corporate balance sheets. I think the concern, perhaps in China, is that they've over-invested and perhaps built too much capacity too quickly, and the economy is just too dependent on that sector, and it probably needs to take a rest. But of course, for a developing economy like China, it perhaps wasn't such a bad idea to build a lot of nice houses.
Right.
And that is, to a large extent, part of the story of increasing prosperity in that economy. The third kind of difference, if you like, is that China has a lot of the Japan story, I always argued, was a sort of a policy story. That is, in the aftermath of the bursting of the bubble, how did Japanese policymakers respond? Not an easy task they had, but did they do the right thing in terms of monetary policy, fiscal policy, and importantly, banking system policy?
Right.
And to cut an awfully long story short, I think the big policy error that Japan made in the 1990s, which kind of ricocheted and cast a shadow into the 2000s, let's say, was that they tried to kind of cover up the extent of the hole that had been blown in bank balance sheets as a result of the bursting of the bubble, the unwind of the bubble. And they tried to grow out of the problem. But being a very mature economy, they didn't have sufficient growth potential. And the deleveraging forces in the economy were so strong that the monetary policy was not working. They were prone to put on the fiscal brakes from time to time. So they really did mess up the policy response. And the advantage that China has, potentially at least, is that they have the Japan experience to learn from.
Right.
And one thing that I learned from my interaction with Chinese policymakers over the years, couple of decades maybe, is that they do look very closely at what's going on in Japan, the US, Europe, etc. They have a lot of sort of policy capacity, people that are sort of take a deep dive into these issues. And I suspect that the lessons have sort of been, learned in the Chinese government bureaucracy and filter up to policymakers. That doesn't mean that they necessarily listen. It doesn't mean that they necessarily will do exactly the right thing. And it doesn't necessarily mean it will all work. But I do think that is an advantage that China has. They can and learn the lessons from Japan's policy mismanagement.
Isn't China's growth rate at this time approximately twice what it was in Japan at that time? I mean, can they kind of grow their way out of this, so to speak?
Well, I think that is kind of my point. But I guess the question is that because the potential growth, I think most people now probably say, China can't grow at 8 to 10% anymore.
No, I was figuring it was like 5 to 6 in reality.
5 to 6. And maybe that's even optimistic given the workforce is now starting to shrink.
Right.
They will need to utilize the capital that they've accumulated.
Right.
They have a lot of capital. They've had this very high savings rate, which has fueled a lot of domestic investment. So can they harness that capital stock in a way that generates productivity in the future? They've also invested heavily in human capital.
Right.
China has a very educated population now, and they put a high premium on investment in human capital that augurs well as well. But, even if growth is, 4% potential growth, if they can sustain that over a long period, that's still not a bad outcome. The other difference with Japan, of course, is that Japan went into macro level deflation.
Right.
And that was sustained for a long time. And what that basically meant was that for a couple of decades, nominal GDP grew at a lesser rate than real GDP.
Right. Right.
So when we talk about growth rates, we just mentioned, let's say China grows at 4 to 5%. If they have 2 to 3% inflation, now nominal GDP is growing at 7 to 8%.
Right.
And economists are trained to say, well, you should look at real variables, not nominal variables.
Right.
But financial market participants are often looking at nominal variables.
Right.
That's what the stock market is.
Right.
The stock market is a nominal variable, which is a claim on real assets, but it's a nominal variable. And so there is something to be said for having 2 to 3% inflation in the economy, greasing the wheels of the economy. So again, a big question will be, can China avoid slipping into a Japan-style deflation? And again, I think they have the instruments, both monetary policy and fiscal policy. Like Japan, they've been running a current account surplus for many years as well. So they actually have a net claim on the assets of the rest of the world.
Right.
So again, I do think they've got the growth potential to sustain growth. However, it's very important, in my view, if I was to advise Chinese policymakers, as you get these failures in the property market developers, even perhaps big Chinese banks that end up with a lot of non-performing loans on their balance sheet, very important, I think, to disclose the true state of the assets,
Right.
write the assets to market, mark them to market.
Yep.
What will that do? That will blow a hole in banks' equity.
Right.
But then the government, perhaps helped with the private sector, has to be prepared to move in and fill that hole, recapitalize the banks. If you do that quickly, and you put the banking system, you kind of clear the debt off, you put the banking system back on a solid footing, then you can unleash that growth potential.
Right.
But it's sort of a circular argument. But if you say, well, we're going to have growth, therefore we don't need to bite the bullet on the balance sheets, right. Guess what, Rob? You may end up not having that growth.
Yeah.
And I would just draw the example of one thing that the US did very well, and you could argue they had no choice because it was much more of a capital markets-based system. But back there in the global financial crisis in 2008, when for my sins I was chief economist at Lehman Brothers and watching the world collapse around me,
Right.
I was very positive about the fact that much as it was a bitter pill to swallow, American policymakers, politicians bit the bullet, put that TARP, Troubled Asset Relief Program, $700 billion in place within a month and a half of the Lehman failure, and then made sure that they injected a big chunk of it very quickly into the banking system. So that would be the lesson I think that China needs to learn. And so if you're a China watcher, as this property market issue plays out, watching for sort of signs of the Chinese policy reaction function. Does it look more like the US? Does it look more like Japan? I think is going to be an important guide to investor, making correct assessments of what's going on in China.
Yeah, I mean, I think that's exceptionally interesting because that's where it really boils down is the disposition of the assets question. That's a huge part of it. Let's pivot a little bit to the broader global neighborhood, to Russia, because there does seem to be this sort of bifurcation in policies in the world where you sort of have Russia and China and everybody else to some degree or another. Russia's been defending the ruble, throwing a lot at defending the ruble, and has a small conflict that it's engaged in now. So, how do you see that block working out, so to speak, within the global context?
Well, I think, Rob, we do live in very kind of interesting, quote unquote, but also somewhat dangerous times because this Russia-Ukraine war, which erupted in February 2022, but which had a lot leading up to it, is a very serious matter. And the geopolitical sort of realignments that are going on in the world are spilling over into the economic sphere. And of course, those two things are quite interrelated. We had, for example, when Russia invaded into Ukraine, of course, the sanctions put in place, and a lot of those sanctions were financial sanctions, including such, not the first time, but certainly the first time for a major economy like Russia, the US moving to freeze foreign exchange reserves and then cut off Russia banking system to a large extent, not completely, but to a large extent from the SWIFT international bank messaging system.
Right.
So, China sort of was watching all of that. And, one thing that's kind of happened in the world is, it looked for a long time like, China and the US were engaged in a kind of a happy economic marriage after China joined the WTO.
Yeah.
But of course, last few years, it's a long story, but that's gone sour to a significant extent. There's some saber rattling taking place now, of course, between China and the US over Taiwan. You have this Ukraine situation. But increasingly, the global economy seems to be realigning into these two major blocks of China and Russia, and perhaps what is sometimes called the global south on the one hand, and the West and the rest on the other hand. And, that's not, from an economic perspective, a very kind of nice thing to have happen. No. Economists like to see trade and prosperity and peace around the world. But that realignment is taking place. And, I think when it comes to Russia, obviously they're hitching their wagon to China now, and to a certain extent, not as much, vice versa. But there is a lot of complementarity between the two economies. Russia has a lot of land, it has a lot of oil, it has a lot of food. It doesn't have that many people, but significant population, maybe 160 million-ish.
Right, but fewer now than a year ago and a year before that.
That's a bit of an issue. Yeah. But China, of course, has a tremendous manufacturing capacity, and it has huge energy needs, and it has very big food needs as well. Mm-hmm. So that is, that's a kind of an interesting kind of story, particularly China being interposed, still having significant trade relations with the US.
Right, sure.
But they could be threatened. But by the same token, has quietly really made it very clear that geopolitically it sits in the Russia camp.
Right, and I think this some of the trade issues are going to get exceptionally interesting, in part because of the war between Russia and Ukraine. That, I believe, has given more oomph to these reshoring ideas in the U.S. I think that used to be a concept, but now I actually think firms are spending money to do it. And that will make things a little bit different. But back here in the U.S., I had to chuckle last week 2 weeks ago when Fitch downgraded the U.S. by one notch, following S&P's move when I think you weren't there.
I think you worked at Fitch.
I did work at Fitch, but following S&P's move by almost a decade. And a large part of, as I understood it, as someone who hasn't worked there in a couple of years and just read this from the newspaper, that apparently what happened was that Fitch's forecast of the total debt pile of the U.S. Was a bit higher than some of the rules around what can be AAA credit. Just to short story it. How do you see all that? How are you reading all that?
Right. Well, you mentioned S&P, and I was there for 6 years or so. I did join the company 2012, a little bit after the downgrade.
Okay, just after that.
And as the chief economist, I would not have been and was never directly involved in sovereign ratings. We had a kind of separate team structure. But the Fitch. A few things maybe to say about the Fitch downgrade. First of all, I mean, having worked in a rating agency for quite a long time, you kind of learn that. Perhaps many of the people on this podcast accepted, people outside rating agencies don't really understand too well, how they operate and what a rating actually means, let alone a rating downgrade. It is a credit opinion.
Yes.
And what the rating agencies do, they have these ratings criteria,
yes,
which is very kind of, basically it's their cookbook for how they arrive at a rating. And they spend a lot of time, a lot of intellectual capital goes into creating and maintaining these criteria, methodology, and it's all very transparent. It's a little bit like central banks. They publish this, so you could go onto the internet and Google, and you could get Fitch's sovereign rating criteria, and at 30 pages, or with appendices, probably more like 50. It's all there. And so the point is, these rating agencies don't just wake up one day and put their finger in the air and say, we're going to downgrade the US.
Right.
They have a very sophisticated and very well worked out and well disclosed ratings methodology. So Fitch downgraded within that methodology. Now, from AAA to AA plus. I mean, AA plus is still a very, very high rating. And I have a little bit, from my perspective, again, it's an opinion. If you agree or you disagree with it, that's fine. Everybody's entitled to their opinion. So I don't think, this idea that you kind of suddenly beat up on the rating agencies because they had the temerity to change their rating is a bit over the top. The point that I would pick up on, and Fitch did pick up on this in explaining, how they arrived at this decision, is that this is very much a reaction, in my view, to the debt ceiling kerfuffle and brinkmanship that we just went through. And if you step back, and if you look in the criteria, and I think S&P is the same, I suspect Moody's is the same, part of in those criteria is this notion of, is there good governance?
Yes.
Economic policy governance.
Yes. Fiscal
governance. Is there good policy credibility?
Yes.
And again, to remind listeners of what a credit rating is, it's an assessment, it's letters, but it's essentially at some level a kind of a qualitative assessment, qualitative/quantitative, I guess, of what is the willingness and capacity of the obligor, the rated entity, to repay their debt in full and on time.
Right.
And capacity and willingness are very important.
Two different things.
And you mentioned my book, The Power of Money. A lot of that book sort of argues that sovereigns have the capacity always to repay their debt because they actually create money in the first place. But institutionally, that capacity might be somewhat constrained because we have different actors involved, and the Treasury is accountable to the Congress, and it doesn't have free reign over the printing press at the central bank. So institutionally, there are constraints. And then, of course, you have the willingness issue. At the end of the day, are the politicians willing to make sure that the US never goes anywhere near default?
Right.
Well, we have this debt ceiling dance that we go through every few years. And, this year, for example, that was resolved, early June, I guess it was. Secretary Yellen, the Secretary of the Treasury, wrote 7 letters, and this is always the case. Well, it started in January. She wrote 3 letters to the Congress in January, another 4 in June. And the January ones were to say, look, we're going to run out of money if you don't raise this debt ceiling.
Right.
And we're going to have to start to default on our obligations unless you raise the debt limit. Now, we've got these special measures that we can employ. They usually last about 6 months. We're going to start doing that. But please, pretty please, lift the debt ceiling. You get to June, still haven't done it. Another 4 letters, Janet writes. The last one was May 26th, just days before the deal was done. And so if you step back, Rob, to me, the big picture story is, can rating agencies credibly say this rating is a AAA when you have the Secretary of the Treasury saying, hey guys, we're on the brink of defaulting?
Yes.
Now, and yes, people would say, yeah, but they're never going to default. But, how do you know that? Another aspect of credit ratings is it's forward-looking.
Right.
Kind of like a forecast of the future. Well, how do you know what the Congress is going to do? So I think a one-notch downgrade certainly can be justified. And you could actually turn it on its head and say, really, is a one-notch downgrade sufficient to capture that dysfunction in US fiscal governance and policymaking?
Right. And that's one of the things that I think got left out of a lot of the discussion after this. Because as you say, AA plus is still pretty good.
Most people wouldn't mind a AA plus rating.
Oh, yeah. 7 out of 8 out of 10, 9 out of 10 countries in the world, probably. Yeah. So, all right, well, Paul, thank you again for being here. Thank you for being a little method to the getting a little method to the madness. There is an awful lot for people to be thinking about right now, and I know the members of CFA Society New York are very happy to have your thoughts on this. And that's a wrap on another podcast. Thank you all for listening. Until next time, I'm your host, Rob Rowan, and this has been Compound Insights.